Hi, folks. This is Mike Zlotnick, and today's discussion is going to focus on how does investing in distressed real estate deals look like in this environment. Recording this in late May 2023, obviously, situation may change, but this is just a high-level framework on what kind of deals you could be looking for. The usual disclaimer before we dive into the discussion itself: this is for informational, educational purposes only. No advice is given, no solicitation. If you're interested to invest, consult with your attorney and CPA professional. So here's the framework. Distress situations are coming, no matter what, for the reasons that the interest rates have risen a lot. There's a lot of pressure on existing owners. And the type of deals that might come forward will fall into essentially a few categories. So number one, there will be desperate situations that are not worth your funding. So we're going to leave those alone, not talk about them, but the deals are underperforming, and then the loan is resetting, and there's just not enough equity to support a fresh cash infusion. So we'll leave those alone. But there are deals that are worthy additional capital, and typically they are with the right operators. So the process of reviewing these deals always starts with who we investing with. And we've done already a few of these investments, and we are razor focused on the most competent, highest capability, highest integrity, highest track record operators, folks who will take the money with a great care and execute well. No guarantees, but usually these are competent operators. The deal just took longer to execute value add, or the interest rate is resetting while the value add is almost finished. So there are two primary situations. One, the loan term matures or rate cap is expiring because the deal took longer to execute for whatever reason. These type of situations need fresh capitals to extend the loan to buy a fresh rate cap. And then the deal itself should be moving on pro forma or close to pro forma while outperforming pro forma. If the deal is severely lagging the pro forma and the debt is expiring, that's not a worthy deal. But for the sake of a discussion, let's just say the value add is almost finished. It's a strong pro forma rents. Basically, rents are beating the pro forma. They just need a little more time. So the property was bought right a while back. The value add just took longer, which does happen. And mortgage rate has gone up, or the rate cap is expiring. So the fresh injection of capital will be a worthy exercise, and you have to underwrite the deal. We'll talk about this, what the underwriting looks like. Another situation is where the loan term is not maturing. That's totally fine, but the deal value just took longer, and it's still running out of cash, and it needs an additional liquidity injection to finish the value add to bring the property to the market in an orderly fashion. But there's no pressure from a mortgage. The mortgage has another, let's just say, a year before maturity or rate term expiration. These type of deals are worth consideration as well. Now let's talk about what kind of investments you can make. So let's take a step back. So you're coming into a situation where the seller is somewhat distressed. They're severely distressed and they're desperate, which you don't want to look at these type of situations. Those are probably the worst. Or the seller is somewhat distressed, or they just need more cash to take the property to the finish line. So these are ideal situations where you can come in with the most senior capital. And the most senior capital can come in two forms. One is effectively mezzanine debt or secondary debt, or debt to the entity secured by all the pledge and assignment of the beneficial interest of the members of the entity itself. It's either private or a recorded public loan. And why do I say this? Sometimes the first lien lender will not allow secondary debt. In that case, you don't want to blow up the first by recording a second. So if you're working with a worthy operator, you can still record some kind of UCC lien on the entity. There's ways to securitize the investment. But for the sake of the argument, we'll worry about the mechanics and the lawyers to work out how the injection takes place. Let's just say it is debt that will be senior to all other money on the deal other than the primary debt. So the bank mortgage is senior on the capital stack. Then there is a mezzanine debt or secondary debt. Typically, when you're coming in with that, you certainly want to get paid ahead of all existing investors. And the terms of the deal are typically pretty opportunistic. So this is a high yield loan with interest rate somewhere between, say, 14 and 18%. There's no right or wrong number. depending on the type of deal, you may be able to get, I would say, probably average 15, 16% rate in these rescue capital and probably a couple of points. Now, the sellers have to be pretty motivated, or the owners have to be pretty motivated to take that money. But the option is for them is either they take rescue capital or they run out of cash. And when they run out of cash, all existing equity will be at risk. So for them, taking on this additional debt is the only path forward to provide potential recovery for the equity investors. Now, you don't want to provide debt into a desperate situation where you have no hopes of the deal surviving. You really have to underwrite the deal, understand what is the current primary debt, what's the projected conservative value of the asset upon complete stabilization in a normal sale. And using today's numbers of what transactions are taking place at, with some discount for economic recession, prices softening. So right now, on the underwriting basis, you have to assume things will get worse, not better. So just for sake of the argument, let's say the deal exit value is $20 million and the primary debt is $14 million. So it's a 70% ratio on a potential sale. And the property needs another $1 million to finish the work and to be brought to the market. So you can actually, first plus the second, plus your $1 million investment would be at 75% loan to value. Now, it feels a little aggressive for this environment, but you can also ask, in addition to interest and points, you can potentially ask for some equity participation. You can ask for a portion of the upside on the deal, portion of the sponsor promote. You can ask for personal guarantee by the sponsor. You can create additional safety mechanisms as part of your loan to have both strong downside protection and great upside in the form of high interest rates, points, potentially some equity participation in the deal as a portion of sponsor promote. Now, of course, this is all going to be give and take negotiation depending on the situation on the deal, depending on desperation of the owner. And at the end of the day, it depends on how many other problem files they're solving and how high their cash position is. So we've already done deals like this, and I can tell you that the situation is already happening, and you will see more and more of these opportunities. So participation in these deals provides, in my view, strong risk-adjusted return to investors. Of course, there's risk. If the deal fails and the first lien lender forecloses, this junior loan could lose all its money. But you have to really gauge what's your downside risk, what are the situations where the deal could collapse or underperform to the point where you couldn't recover your money. So you need to do a little bit of sensitivity analysis on the sale price. You need to do a little bit of analysis on the execution. But if it's well underwritten, you could have strong risk-adjusted return. So similar to the debt investment, which is, in my view, is probably the preferred option, debt with high interest rates, personal guarantee, number of other defensive mechanisms, potential upside, maybe some equity kicker. The alternative to that becomes preferred equity. So preferred equity would also put all existing equity, all other money in the deal other than the primary debt, be subordinate to the fresh money. The preferred equity comes in typically with variable, well, it could come with fixed rate terms plus a variable kicker plus part of the common equity upside. The preferred equity deals, the difference between preferred equity and the debt deals is debt has to be serviced. So typically, if you're coming in with a debt and you're putting in an interest rate of 15% on the deal, you may require it to be paid current, or you may require 10% of it to be paid current, 5% to be paid on an exit. So there's ways to negotiate the terms. Preferred equity, all preferred equity could be deferred. So the difference between preferred equity and debt is debt generally needs to be serviced to whatever degree, and preferred equity typically can defer. So you can come in with the high preferred equity rate, structure something pretty similar, 14%, 15% preferred equity, plus an additional upside in the deal, some portion of the promote. And at the end of the day, it starts with the sponsor, underwriting, being comfortable that they can execute. Two, the deal itself has sufficient downside protection and sufficient upside economics where you could generate really attractive risk-adjusted returns on the fresh money, at the same time minimize the downside. So those are the two primary use cases, either secondary debt, mezzanine debt, or a form of preferred equity. And part of the negotiation, you can also negotiate for control provisions. With preferred equity, you can actually ask for the ability to replace the manager if they're underperforming. And in both cases, secondary debt or mezzanine debt or preferred equity, you definitely want to have the sponsor or the operator commit to monthly reporting and have consequences to their position if they don't report on time. So they could lose control. They may be required to surrender their whatever investment they have in the deal. As fresh money, you can negotiate anything. You can come in and put a lot of pressure on the sponsor, not in a bad way, just to give them alignment of interest. If they perform, they have good upside. But if they don't perform and you are seeing underperformance, you should be able to step in, replace them, and have other consequences to the underperformance. On a loan, you can also request cross-collateralization. In other words, you can request that the primary debt would be on this property, and there could be some cross-collateral on another property where there is better equity position. So just a high-level framework, these opportunities are coming, and fresh capital will have very attractive, most likely, risk-adjusted rates of return for new investments. Of course, strong underwriting will be required. Of course, strong network of operators will be required to get to the right people, because there are a ton of folks who will be in distress, and they are not vertically integrated, strong operators without ability to execute. These folks, giving them fresh money is like putting good money after bad money. So you got to be really careful on that front. However, if you pick the right operators with the ability to execute with the right financial position, negotiate the terms in a manner that protective to your fresh investment while providing you strong upside, you may wind up with a phenomenal return opportunities in the upcoming months. So stay tuned. Interesting deals are coming. So appreciate your time and attention. Until the next time. Thank you.